What is the core and satellite investment strategy? And why should you even care? Because in my opinion, it is an outstanding way to have your cake and eat it too. What do I mean? Well, if you're a one-on-one client of mine, you've probably heard me talk about the core and satellite investment strategy. It's an investment strategy that keeps the majority of your investment assets adhering to long-term goals while also allocating a predetermined amount to a more targeted asymmetric investment opportunities without jeopardizing your overall strategy. The core and satellite investment strategy is an investment approach that involves dividing a portfolio into two distinct parts, the core and the satellite. This strategy is commonly used by investors who want to achieve balance between a low-cost, long-term, diversified portfolio aimed at achieving market-based returns and the inherent risk-taking that many of us have that many times can disrupt the long-term investment process. The core portion of the portfolio is designed to provide stability and act as a long-term foundation, while the satellite portion, it's used for more aggressive or specialized investments. Now, before I get into the specifics of the strategy, here is a perfect spot to point out important disclosures. The information in this video is for educational purposes. This is not specific financial planning, health insurance, or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. All right, here's a breakdown of how this might look. First, the core portfolio. 85% to 95% of assets and systematic investments are attributed to the core portfolio. Investments are typically low-cost index funds intended to be broadly diversified and thus limiting single stock risk. The core is based on actual statistics and investment characteristics that have been what I like to call evidence-based. Meaning there isn't any gut instinct here, any I think this may happen so let's do this. It's a long-term investment based on historical evidence of best practices. Common assets in the core portfolio typically include stock index mutual funds or exchange traded funds called ETFs. These provide exposure to a broad market index like the S&P 500, offering diversification for a low cost. They also include individual bonds or bond ETFs. These often include a mix of government, corporate, or municipal tax-free bonds that can provide interest and more price stability than stocks. A common implementation of this is what is often called the 60-40 approach. 60% of assets in stock investments and 40% in bond investments. All right, now that you understand the core, the satellite portfolio. 5% to 15% of your investable assets and systematic investments are often attributed to the satellite portfolio. Because these investments often have higher return potential than the core portfolio, but also a much higher potential for negative or even catastrophic returns, I believe their allocation should be limited to 5 to 15%, depending on your tolerance for volatility and, most importantly, your time horizon. The younger you have, the more opportunity you have to make these more specialized investments because you've got the time to let them play out. Satellite investments are typically more thematic in nature, a certain investment theme or idea that you've been researching that you believe will play out over time. For example, investing in alternative intelligence companies, biotechnology stocks, clean energy like nuclear power, or mining exploration. Now, common assets in a satellite portfolio typically include individual stocks of companies that are poised to potentially take advantage of the trend, or sector-specific ETFs that have more diversification than a few individual companies but are concentrated in an investment theme. Country-specific ETFs, if you believe a certain area of the world is poised for above-average growth, or alternative investments like private equity, venture capital, or cryptocurrencies. And alternative investments like these often have additional risks that include a lack of liquidity. Now, often the goal of satellite investments is to have a return over time in excess of traditional market returns. And in some cases, 2 times, 3 times, 4 times, even 10 times the return of traditional investments. Now, some do and some don't. Stocks like Amazon or Tesla have had huge risk of failure, but over time have significantly outperformed the general market. But stocks like WorldCom, Texaco, and Enron went bankrupt. And the idea behind the core and satellite strategy is to achieve a balance between a long-term diversified growth and the desire many individuals have to invest more aggressively. It can create explicit parameters to ensure poor satellite investment picks don't derail your long-term plans. I see that all the time when people come to me and show me their portfolios. It's something that they've done where they've accumulated more and more investments that don't adhere to their long-term strategy, and they become 15, 20, 25, 30, 40% of their investment portfolio. The reason the core and the satellite works is because your satellite strategies are a specific amount of your portfolio, but it also provides enough capital where outsized returns from your correct picks can still dramatically change your life. There's no need to try and YOLO your way to investment success and potentially derail your financial future. The core satellite approach can be an excellent way to achieve the best of both worlds in the pursuit of higher returns and specialized opportunities. Of course, this isn't the only investment strategy out there, and you want to find one that makes sense for you. And if you'd like to learn additional investment strategies for dealing with uncertainty in the financial markets, you should check out this video next to help supercharge your personal finances.